Welcome to our full breakdown to Bollinger Bands, an essential tool for developing trading methods. In this video, we'll go over how to use Bollinger Bands to spot breakouts, reversals, and pullbacks. You'll discover how to use this powerful indicator to generate high-quality trade entries. By the end of this video, you will have a solid understanding of Bollinger Bands and how to use them efficiently. So make sure to watch the whole through. Every detail is important. Here's what we'll discuss in this video. First, we will look at the fundamentals of the Bollinger Bands indicator. We will look at the concept of volatility and how it is reflected in Bollinger Bands. Next, we'll look at three basic Bollinger Band setups: breakouts, reversals, and pullbacks. Well, let's dive right in. Now let's get back to the fundamentals of Bollinger Bands. Understanding Bollinger Bands as a volatility indicator necessitates a thorough understanding of volatility. Simply explained, volatility is the rate at which the price moves. Prices do not move at a consistent rate. Rather, they alternate between periods of low and high volatility. In a low volatility environment, prices move slowly and cover little distances over long periods of time. We see minor, disorganized price swings with red and green candles lacking major momentum. These low volatility conditions are commonly referred to as sideways or range-bound markets. Trading in such conditions might be difficult due to the limited price fluctuation. However, the movement is quite organized and predictable, allowing for small, measured trades. In contrast, in high volatility settings, prices move swiftly, resulting in large swings and big candles. These quick changes are characterized by great momentum, creating a variety of trading opportunities and obstacles. High volatility conditions are commonly referred to as trending markets. Trading under such situations can be quite simple, but it necessitates aggressive entries and exits because the price might swing dramatically in any direction. As a result, in a low volatility environment, it is important to take a conservative trading technique, whereas in a high volatility environment, an aggressive strategy is more acceptable. So, how can you distinguish the various levels of volatility? This is where Bollinger Bands come into play. The Bollinger Bands indicator is intended to help you evaluate market volatility. It is made up of three lines: the middle, upper, and lower bands. The default parameters are a 20-period moving average with two standard deviations. The middle line shows a basic 20-period moving average. The upper band is computed by adding two standard deviations to the middle line, while the lower band is determined by subtracting two standard deviations from the middle line. During times of low volatility, the bands constrict and become quite narrow, with the price moving sideways within them. The price frequently fluctuates between the upper and lower bands, although it mostly stays within them. When the price closes above the top band, it typically reverses downwards. When the price closes below the lower band, it typically reverses upward. In high volatility scenarios, the bands widen and expand, and the price frequently remains near to the upper or lower band. In an up move, the price will continue near the upper band, indicating the market's strong momentum. The price may close a few candles above the upper range before reversing. Similarly, in a downtrend, the price may stay around and around the lower band, with multiple candles closing below it without reversal. This behavior demonstrates how Bollinger Bands paint a clear picture of market volatility. For those using a trend trading technique, it is best to avoid initiating trades while the Bollinger Bands are narrow. Trade only when the bands are wide. If you are looking for reversals, you should avoid trading when the bands are wide, and instead trade when the bands are small. However, it is vital to remember that trading should not be done based entirely on the size of the bands. A well-defined strategy with a robust set of principles is required for profitable trading. If you found this video helpful, please like it and subscribe to our channel, Trader Yoda. Let's get back to the video and look at some simple setups with Bollinger Bands. Setup 1. Breakouts. A breakout happens when the price exits a sideways market and enters a rising phase or trend. By entering at the proper time, you can catch a big move with a very tight stop loss. Bollinger Bands can help you pick the best timing to enter these breakouts. First, we must identify a sideways market. Look for places on the chart with relatively thin Bollinger Bands, which indicate a time of consolidation. The price should also be trending sideways at this time. Once we've identified such a market, we must check that the price has stayed within the bands for the most of the sideways range. In this case, the upper boundary of the bands served as resistance, while the lower boundary supplied support. We then wait for the price to break through the Bollinger Bands. For example, if a solid green candle appears and closes above the top band, it implies strong market momentum. Because the price normally remains within the Bollinger Bands, such a breakout indicates a considerable shift in market force, making this a valid breakout scenario. This is an example of a bearish breakout. Observe a tight sideways range with pushed and thin bands. The candles have been inside this narrow range for a long time. The upper band has served as resistance, while the lower band has supplied support. So we classify this as a tight range and wait for the price to break above or below it. When the price breaks and closes below the range, as indicated by a large red candle and a forceful close, this is a proper breakout setup. Setup 2, Reversal Setup. Bollinger Bands are a useful tool for trading high probability reversals. As previously stated, the price typically remains within the Bollinger Bands. As a result, when the price breaks through or hits the upper or lower bands, a reversal is frequently expected. Let's start with the sales setup. Here we see that the price was moving in a sideways range, trading within the bands, with the upper and lower bands containing the price. On this candle, the price approaches the upper band before instantly reversing downward. The price then advances to the lower band and briefly touches the upper band before reversing. The price ultimately reaches the lower band again. For a bullish reversal scenario, note that the price reaches the lower band on this candle before quickly reversing upward. The price continues to approach the upper band, suggesting that reversal setups can be effective in this situation. Setup 3, Pullbacks. Pullbacks with Bollinger Bands are one of the simplest setups. To trade pullbacks within a trend, first identify the market trend. When the price moves between the upper and middle bands, we consider it to be in an upward trend. In such an uptrend, we seek out buying chances at pullbacks. The price often returns to the middle band, so we buy when it reaches this level. Similarly, if the price is trading between the middle and lower bands, we call it a downtrend. In such a downtrend, we search for opportunities to sell during pullbacks. These pullbacks frequently occur in the middle band, therefore, we focus on selling around this level. The three most common Bollinger Band settings are as follows. To improve your trading strategy based on these setups, include more confluences to identify high probability trade opportunities. Confluences can take the form of support and resistance levels, candlestick patterns, trend lines, and other indicators. That concludes our video. If you found this content useful, please like and subscribe to our channel, Trader Yoda, so you don't miss any of our new videos. See you soon.